The other observations I want to make is really about order flow. You know, there's huge amounts of regulatory pressure on certain types of liquidity providers. Speculators, we all know about that one. High frequency traders, we know about that one. Bank proprietary trading, they're going to have to put up more capital to support their proprietary trading activities. And indeed, we may find Vickers and the equivalent elsewhere. And now we know the European Union is starting to look at bank breakup into risky activities and non-risky activities, or traditional banking activities. How is that going to impact order flow into the markets? We also know that financial portfolio managers are swept up in the debate about speculation, so they may find themselves constrained about what kind of order flow they can put into markets. Short sellers, it goes on and on and on. The chances of this actually having a significant impact on the smaller markets is quite serious and quite realistic. Taken together, you could find that some of the smaller markets are going to struggle. And if you talk to most of the real economy end users in the marketplace, they would all say, we want financial players in the market. We need that for liquidity. So all of those things I think are quite important. The other element to this which will impact on order flow is cost. You know, establishing super safe markets will not come cheap. Somebody has got to pay. If you look, clearing fees will probably go up because clearing houses will be much more intensely regulated. Margins are likely to be set at a super safe level, and already for those of you who've read, and I talk about the European perspective here, the ESMA paper, you will see they're talking about buffers on margin. They're talking about all sorts of things which are going to put margin up, probably called on an intraday basis much more frequently, and will be supported by limited forms of highly liquid assets as eligible collateral. Just parcel all that up, plus the pass-on costs that the intermediaries will be passing down to the end users, and you have quite a big additional cost. Because don't forget, a lot of those end users who were trading in the OTC markets didn't have to meet margin calls, weren't constrained about the kind of assets they had to put up as collateral. Suddenly now, for exposures where they didn't have to do that, they're now going to have to do it. So actually, trading in the marketplace is going to be an expensive business, whether it's for risk management purposes, pure trading purposes, investment purposes, doesn't matter what it's for, it's all going to get a lot more expensive. And for some, that will have an economic consequence. And it may be even to the point where some end users will say, you know what, it doesn't make economic sense for me to trade as much in the market for my risk management purposes as I used to. I'll just price the risk and pass it on to the customer, my customer. I won't bother to manage it. I'll price it and pass it on. So we just need to think that there are some economic consequences in all of this we need to bear in mind. The other point I wanted to make was we are in a world now of extraterritorial application of domestic rules. And we've seen it from the States, we're now seeing it from Europe, and I'm sure we'll see it in other jurisdictions as well around the world. So the idea that we want to internationally grow our markets is going to be impaired by the cost of accessing what to us are foreign markets. And there will be difficulties in doing that. So yes, we talk glibly about regulatory recognition, but actually when you start to look at the conditions of equivalence, the conditions of reciprocity, to the point where even though you may come from a highly well-regulated jurisdiction, I have no problem with you at all accessing and doing business in my market. Nevertheless, if you don't give me the same equivalent level of access, I'm not going to let you in, no matter how well-regulated you are. So there's a real issue, and again, I talk from a European perspective, about linking recognition with reciprocity. And is that actually going to open up the markets in the way that G20 envisaged? Because remember, they said very clearly, we do not expect, and they made this point very clear at the outset, we do not expect the crisis to become a means of developing more protectionism and putting up more hurdles to international access to the marketplace. So a few thoughts to kick us off. Last one. MiFID I was really about market liberalization. MiFID II is more about market compression. In some respects, rightly so, but not in all. And I think we have a real problem in the sense that before the crisis, markets were designed to meet the end user's needs. It was the end users, the intermediaries and the markets that designed the marketplace, such as it is, with its diversity and its innovation and all those other good things. Post the crisis, it's the regulators that are now shaping the markets. And before, the regulators had to work around the marketplace as it was designed for end users. Now it's the other way around. End users must work around, to some extent, the marketplace, which is now being designed by the regulators. So, as I say, a few thoughts to kick us off. What I'm going to do now is hand over to Fred Greed.